Real mortgage questions. AI answers. One broker who tells you what it actually means. I'm Edward Brady, a chartered financial analyst and broker at eXp Realty. Opinions are my own and not that of eXp Realty, its management or staff. This is Mortgage Questions. Let's get into it.
Investor loans depends on the property type, the risk tolerance, but how does the underwriting mindset change when cash flow matters more than income? So that would entail 5 units and above, is that right?
So when we're looking now at an investor standpoint, almost all the time, I would say it's more on the property itself, the asset itself, than the person purchasing it. Really what we're looking at for the purchaser is more their FICO score to help determine the rate impact. But mostly when we're looking at an investor standpoint, it's what the asset, it's cash flowing itself. And can the property survive any vacancies and overhead expenses, and will it debt service? That's the most important part. Is it debt servicing itself? So it's more a ratio. So typically they would like to see a 1-to-1 ratio. So whatever the mortgage payment is versus how much rent it's coming in, they would like to see that 1-to-1 ratio. There's some banks that could land on negative ratios up to a 0.75 to 1 ratio. And then typically anything above a 1-to-1 is always just more favorable to you.
By 1-to-1, you mean net operating income, not gross rent, right?
They look at gross. It's just whatever is coming in. So whatever the gross income is. So for you as the investor now to look at it in two lenses, I know I could qualify with just the 1-to-1 gross income, but what are my net operating expenses going to be to help me really see if it makes sense for me? Or is this property that's going to be able to be occupied more times, or am I going to have to fill vacancies a lot more?
But that depends on the lender, right? Like some lenders are more aggressive, like you're talking about 1-to-1, and some are more conservative.
Yes, there's two ways people look at it. We have more long-term investors now. What they look at is the same 1-to-1 ratio of how much of the mortgage payment versus the rent. Now, there's other investors who are looking at more like that short-term rental strategy. You don't have that consistent renter in there month to month. It's more of a revolving hotel. People come in, check out, etc. More business operating. And what they're going to look at is through third-party sites.
Airbnb, you're talking about Airbnb, is that right?
Correct. So a popular one is if you're trying to Airbnb a property in the Los Angeles area, the most very popular snow area is Big Bear, like Arrowhead area. So a lot of these are used for short-term rentals, for vacation rentals. And one might weigh out if someone was trying to purchase this property, a long-term renter in there versus putting something as like a short-term equation into it, I would see what's more profitable for an investor. Typically, they're going to have your seasons where it's going to be very popular, but you could demand more income at that short-term prices versus that you had just a regular long-term rent there. And I would just say, depending on your model, what kind of investor you're trying to be, whether it's long-term versus short-term play, see also what that yield will look like, what the difference is between that long-term versus short-term rent. You're going to get a higher revenue doing the short-term model, but you have to also factor in those vacancy periods, maybe not in the spring, summer, and winter times. How are you going to continue to keep it occupied so it's consistently generating that income, or at least income throughout the year?
Okay. So we're talking about as investors, when does a traditional lender kind of step off, and when does a portfolio lender typically step in? And usually what triggers that transition, and how does a borrower's experience change, if at all?
So portfolio lending can be looked at in an array of different things. When we're, again, looking more for investors, the best way to think about it is you can get a investment property through a conventional loan. But with that, there are going to be a lot of barriers. One of them being you have to qualify on your income as the borrower. When you're looking at these portfolio loans that are specific for investors and investment properties, there's some degrees where we could just qualify on the investment income that the investment makes, not what the borrower is making. So a lot of these times it might be more advantageous for an investor to go an investor route with this portfolio loan called a DSCR loan, or debt service coverage loan, where it's really a ratio loan, where it's basically looking at what the property makes, not what the investor makes. So in case something happens where you might be not there income wise to qualify on your income and yourself, you could qualify on what the property is making, what the asset is making. But the trade-off, more times than not, is that you're going to be having maybe a little bit higher interest rates than what you could get through a conventional loan. But the trade-off is that they close maybe quicker if you need to be aggressive on an offer, knowing that it's debt servicing at that 101, or maybe sometimes more, sometimes a little bit less. It's a lot more aggressive to go that portfolio way versus the more conventional way or traditional way.
Okay. When does it make sense to get the additional cost of a portfolio lender, and when should they avoid a portfolio loan?
So if you're someone who doesn't want to go the conventional way, trying to purchase with your money and the income you earn, there are ways where, as long as you have the down payment and the assets to purchase the property, you could still buy investment properties. And it might be a great way to leverage the assets you have if you don't have the income, right? You're just looking at the asset itself. So a lot of investors want to just buy properties that are cash flowing, right? And later they want to close quick and want to find properties that they can maybe just continue to acquire. So this is a great way to continue that strategy and not have to consistently think about, how am I going to qualify for the loan? How am I going to be able to buy this property? So we're not taking into consideration your income.
From 1 to 4 units, it's pretty much the same. It's all considered really traditional financing. But I know that over 5 units, it changes everything. But what's the biggest mental shift that investors need to make when financing larger properties?
It's super easy. The biggest one is making sure you have now the down payment. You have the liquid assets to purchase at that higher price points. A lot of the times when you're looking anything 5 units and above, it's now at the term of commercial use, right? So one of the things that a misconception is, I just need to put 20% down, but not necessarily that's it. It's maybe increased from anywhere from 30 to 50%, just depending on the asset itself. And then the second thing you want to look at is really what they care about is a debt servicing. Are you cash flowing enough income to purchase that property?
What's the biggest surprise make that transition to 5 units or above?
Not having the experience to maybe take on bigger units and not being aware of what that all requires. A lot of it is just having more assets. A lot of times they maybe want to buy a commercial property because maybe they have a restaurant. They want to own the building that they have the restaurant in, but sometimes they don't have the assets or the liquid assets to purchase that type of property yet.
I know a lot of flippers use hard money loans, and they're really told to focus more on exit strategy and speed versus really rates. But how should a flipper evaluate the fees, the terms, and the risks differently from a long-term investor?
They want to make sure that their numbers are super dialed in, right? From the acquisition to any type of construction that they're going to have, and making sure that their values at the end is going to meet whatever they need to get profit. So I would say it's structured differently because of that. Their game is to get in and get out as soon as possible and make the most amount that they can to reinvest to the next one.
Terms, as a loan agent, would you be looking as a potential deal killer or things to advise a flipper to watch out for?
When you're talking about terms, I would say experience. And I say that because a lot of times I've had first-time investors come to me and asking, hey, I want to try doing this flipping idea or buying something to hold later on. And I'll ask them what their experience is. And most of the time they don't have any and they don't know how to structure it. And so for the banks, the hard money lenders, anyone you're trying to borrow money from, that's the risk. So you put yourself in a better position to get more favorable terms, more favorable fees, more favorable rates. That might be maybe doing a JV with someone who's more seasoned in this business and learning with them in your first deal than taking it on by yourself because you might be more profitable, but and later on you might be actually encountering more problems that you can maybe overcome with a partner in the beginning. So something I would say is making sure that you're looking at it in a way of, okay, will this be a smarter move to doing it with a partner who could get me from start to finish and me understanding it so I could gain my experience versus me taking it on, getting more profit, but I might encounter problems that I might not know how to overcome